This video covers the Chapter 4 workbook solutions and corresponds to video 6 of my lecture series on the closing process. If you don't have the workbook for whatever reason, you can still follow along as the questions and solutions will be entirely presented within the slides. The following exercise can be found on pages 8 and 9. Depending on which version of the workbook you have, it may have an error. If you have a $350 unadjusted balance in salaries payable, please change it to a 0. Starting with that first adjusting entry for prepaid insurance, $375 of insurance has expired, so we'll debit insurance expense and credit prepaid insurance for that amount. Our expense entails a decrease in equity via the consumption or decrease of an asset. Obviously, we would then post these entries to their respective ledgers. After doing so, if your company uses a spreadsheet that shows both the unadjusted and adjusted trial balance, you would then post these adjustment amounts here as well. Consequently, prepaid insurance will end up with a $125 debit, and insurance expense will now have a $375 credit. Entry number 2. Depreciation to be recorded on office equipment is $400. This adjusting entry will consist of a debit to depreciation expense and a credit to accumulated depreciation for $400. The debit to expense decreases equity, and the credit to accumulated depreciation decreases assets. Bring these amounts into the adjustment columns of the spreadsheet. Accumulated depreciation will now carry a $580 credit, and depreciation expense will have a $400 debit. Adjustment number 3. $350 of salaries are owed to Southern Equipment Company's employees. Here we have an accrued expense, so debit salaries expense and credit salaries payable. Post the amounts in the spreadsheet and observe the updated balances in salaries payable and salaries expense. The accounts that weren't impacted by these journal entries will have the same adjusted balances as their unadjusted balances. Note that in the unadjusted columns, total debits matches total credits. If the total debits and credits in our adjusting entries also equal one another, then the debit and credit balances of the adjusted trial balance columns will also reconcile. You can verify these totals by pausing the video and summing up these two columns if you like. Oftentimes, the spreadsheet will also have income statement and balance sheet accounts. These are meant to simplify building the financial statements by ensuring you put the right account balance on the right statement. The revenues and expenses go in the income statement columns, and assets and liabilities go in the balance sheet columns. At this point, I want to call attention that you will not pull over the balances for owner's capital and owner's drawings. Remember that these amounts on this spreadsheet will be used on the statement of owner's equity, and the end result of that financial statement goes in the balance sheet's owner's equity section. Also note that the total debits and credits of these columns will not match. Revenues will seldom, if ever, equal expenses. The difference between the two will be the net income amount. As for the balance sheet columns, those two can't match without the owner's capital balance from the statement of owner's equity. That aside, if the totals of the adjusted balance columns equal one another, The asset, liability, and equity sections of the balance sheet should reconcile. If they don't, the error is likely in how the balance sheet was built or in the tabulation of its totals or subtotals. With this table prepared, we can now build our financials, starting with the income statement. The income statement just shows the difference between our revenues and expenses. Start with repair revenue, our only revenue item, then list expenses. With a single-step income statement, expenses are listed in order of decreasing materiality, meaning you start with what is usually the most significant expense, then work downwards. This is not to say that the first expense will always be the largest, or the last will always be the smallest, but that's commonly the way things work out. Tabulate the total of expenses, subtract that amount from revenues, and we have our net income. Next, we pull the owner's capital and drawings amounts to build our statement of owner's equity. We start by listing the beginning year owner's capital balance, then add in the additions to owner's capital from contributions and the net income from the income statement. We then have to look at the actual ledger account for owner's capital. If this year is indeed the very first year of operation, owner's capital has a beginning balance of 0, and the owner invested $2,370 to yield its balance. In this case, the statement of owner's equity will appear as follows. However, if $2,370 is the actual beginning balance, and the owner did not make any contributions, the statement of owner's equity will be as follows. Next, subtract out our withdrawals. This amount will always be whatever balance is in the drawings account. No need to analyze it. Sum our additions with the deductions to yield the net increase or decrease, then add that to the beginning year owner's capital balance to get the year-end amount. This section of the statement of owner's equity will be the same in the alternative scenario. Now we pull these amounts to build our classified balance sheet. On the balance sheet, we start with assets. So far we've talked about current assets and plant, property, and equipment. Our current assets are those that will convert to cash or be used within 1 year, including cash itself. For SEC, those will be cash, accounts receivable, and prepaid insurance. Sum these items to get total current assets. Next, we do PP&E, our long-term assets. There are multiple classes of long-term assets, like financial investments and intangible assets, but we're just working with PP&E. SEC has office equipment and the related accumulated depreciation account. Remember that office equipment carries a debit balance, but accumulated depreciation carries a credit balance. Consequently, the two will net against one another to get total plant, property, and equipment. Combine total current assets with total PP&E, and we have total assets. Next comes our liabilities. Just like assets, liabilities can be categorized by current and long-term, but SEC just has current liabilities. Current liabilities are those that will be paid within 1 year and out of current assets, namely cash. Total accounts payable with salaries payable to get the total current liability amount. Our last section is equity. Pull the owner's capital amount from the statement of owner's equity, add it to total liabilities, and we have total liabilities plus equity, which ties to total assets. The final topic of this chapter is devoted to closing journal entries. In summary, we need to move the balances in our revenue, expenses, and drawing accounts into owner's capital. This way, the balances in these accounts next year will only show next year's activity. First, we'll close out revenues and expenses. Revenue carries a credit balance, so we need to zero it out with a debit. Expenses carry debit balances, so we'll zero them out with credits. Our journal entry is now out of balance, and we need a $1,500 credit before it's completed. That credit goes to owner's capital, the account to which we are moving these balances. Now, owner's capital has a credit balance of $11,500. Next, close out drawings. With its debit balance, the credit to drawings will move its balance to zero, and owner's capital credit balance will decrease to a $10,300 credit. This is not how your textbook shows it, but another, perhaps more intuitive way to prepare closing entries is as follows. Instead of one entry, we'll move the balances in revenue and expenses to owner's capital separately. First, debit revenue and credit owner's capital. Doing so clears revenue to zero, moving its credit balance into owner's capital. Do the same for expenses. Credit salaries expense and rent expense, and debit owner's capital for their combined balances. Expenses are now at zero, and owner's capital has an $11,500 credit balance. This result is exactly what happened after closing out revenues and expenses in the previous slide. We were at that $11,500 credit balance, but we arrived there via one entry instead of two. In that example, the $1,500 credit in owner's capital is just the net of the $2,000 debit and $3,500 credit we just booked. Close out drawings just as we did previously. That entry is unchanged. Drawings is now at zero, and owner's capital is now at $10,300 credits. Again, this is the identical result under the previous method. Either method will get you the correct balances. In my class, I don't care which method you use as long as it's performed correctly. If you're taking financial accounting at a different school, refer to your instructor for which method he or she prefers. Yet another way you may see closing entries booked involves an income summary account. The income summary is most commonly used among the latter of the two previously described methods. The only difference is that revenues and expenses are put in an income summary account, then moved to owner's capital. For example, the first entry would debit revenue and credit income summary. The second entry would credit expenses and debit income summary. Once all revenues and expenses are zeroed out, income summary should have a credit balance that matches net income. After all, net income is just the difference between revenues and expenses, the two amounts booked to this account. This is also the very purpose of the income summary account. In companies with many revenues and expense accounts, verifying that the income summary balance matches net income helps ensure that no accounts are overlooked in the closing process. Next, close income summary to owner's capital. Then close drawings to owner's capital. Once again, we arrive at the same ending balance in owner's capital. Any of the previous three methods will get us to the correct result. That concludes this video on the Chapter 4 Workbook Solutions. If you have any questions about the material, feel free to leave them in the comments below.